Hi, this is Seewing Yee, and today I'm going to talk about the nationwide epidemic of insurance crisis. This is very interesting information I'm going to share with you. This applies to mainly this article came from Resi Club. Resi Club is a up and coming real estate data tracking firm, which is I really admired. They provide some very great objective data. So although the article talks about investors, how real estate investors feel about their properties in terms of the insurance crisis situation, it also applies to potential homeowners as well, owner-occupied buyers as well. Without further ado, let's dive in to this article. It was dated pretty recently, again from a Resi Club. Lance Lambert is the co-CEO of this housing tracking website. So anyway, the headline is home insurance shock has investors concerned. By the way, in case you do not know, I own a real estate investment club for the past 20 years, and we help hundreds of our real estate investors to buy cash flow properties in many areas of the country, in the Midwest and in the South and Southeast. So this article hit the spot in terms of what our investors and what you guys out there, whether you are real estate investors or regular primary home buyers, you need to understand how the recent insurance shock is going to affect your home purchase or your and pending home purchases and everything else. All right. So very interesting article. So stay tuned. So here it is. The average U.S. home insurance premium rate rose 11.3% in 2023. We're waiting for the 2024 rates to come out, hopefully in the next few months. But I can't wait until we see the 2024 data. It could be ugly. Okay, that increased 11.3% since 2023. Average U.S. home insurance premium rate. That was double the 6.6 increase in 2022 and far above the pre-pandemic increases in 2018, which is at 3.2, and 2019 at 2.5. In the past, 5 years, the insurance rates nationwide has increased incrementally from starting at 2018, 3.2, then 2019 to 2.5, then all the way up to 11.3. So it's really double-digit increases in insurance. Relatively small survey as conducted by Resi Club concluded this month. I think only several hundred investors were surveyed, but it's a good start, right? 80%, and the result are 80% of the investors who own rental properties nationwide told Resi Club on this survey that they are concerned about future increases in home insurance. Of those, 37% are very concerned. So what does this mean? This means, look, investors, especially mom and pop investors, many of you are out there listening, hopefully, and our investors as well, we buy for positive cash flow. Normally, we buy for 25% down payment. As a rental property, we achieve positive cash flow. And the areas that people can achieve positive cash flow are mainly in the Midwest and South and Southeast, where where we buy entry-level homes and match it up with those rents so we can achieve rental good cash flow. Whereas in most other part of the country, in the West and the Northeast, pretty much you cannot cash flow because the higher home prices compared to the lower rent will make this investment not attractive. Okay, so when you have insurance increases, that alone could impact the cash flow for those investors. So that's why they are concerned. If the insurance rates keep on continue going up faster than the rate of inflation, like 5 to 10 to 15% insurance rates increase potentially year over year the last few years, then the cash flow would be impacted, and that will make the investors' purchase of future rental properties very challenging indeed. So do you understand what I'm trying to say? All right. This segment in this podcast, I'm just talking about insurance crisis that may impact the cash flow. Cash flow is hard to achieve as it is anywhere in the country, given today's housing environment, when you add on the potentially higher cost of insurance, that can impact the cash flow, and that makes a potential future purchase of a rental property very challenging without good cash flow. Okay. Not only that, we're talking some higher property taxes in certain areas of the country will add on to that, to this challenge of cash flow challenges. All right. Hope you understand what I'm trying to say. All right. So let's get back to the article in question. And the insurance, how concerned or housing investors are about future home insurance premium spikes. And the survey was conducted. On the left hand of the graph, the brown color shows very concerned. The orange color shows somewhat concerned, and the light blue color shows somewhat unconcerned, and the darker blue shows very concerned. So let's briefly dive deeper into this. So in the Midwest, 1/4 of the survey of the investors show very concerned. In the Northeast, 20%, Southeast, 41%, Southwest, 56%. That's a little bit surprising. In the West, 37%, in nationally, 37%. Then somewhat concerned, you're right in the middle gap, we have 43, 56, 45, 26, 44, and 43. And all the way to the very unconcerned, we have 10%. Don't know the rest of these. He's missing the percentage. I can't tell you exactly what the Northeast and Southeast indicates, but in the West is 7%, nationally is 5%. So let me use my past experience of 20 years investing, rental property investing, why some of these. Let's focus on the very concerned categories. The highest level is somewhat surprising, Southwest, 50% of investors surveyed, they are very concerned about higher insurance costs. Southwest, we're talking like the Sun Belt in the Las Vegas, Arizona, New Mexico, and those areas. So if the Southwest has the highest percentage of very concerned, they're probably talking about maybe the wildfires in those areas. Interesting. The hot weather and the water issue, maybe. There's not too much natural disasters going on in the Southwest. I don't see too much hurricane or weather. So that's super surprising. Whereas the Southeast, 41% are very concerned of the investor survey. Obviously, especially along the coastal Atlantic coast, Southeast means like North and South Carolina, Georgia, coastal area, of course, and Florida, and the Gulf Coast, Alabama, Mississippi, Gulf Coast, Florida, and Gulf Coast, Texas. So 41% is pretty much in alignment of the fairly high, relatively speaking, for those investors that are very concerned. And the West Coast is, of course, coastal California, Oregon, Washington, and the Pacific Northwest, 37%. So relatively low. So nationally, 37% of investors survey says they are very concerned about the future home insurance premium hikes. Oh, look, one thing I'm going to say this. I'm not going to create this doom and gloom and narrative stating that because of the high insurance costs, in the future, real estate investors should not buy rental property because of the higher insurance costs, right? So in the insurance cost is merely one component of an investor's ability to analyze whether they should buy a property for positive returns or cash flow, right? So just one component. You have to look at the entire component, like the rent you're collecting, how much is a mortgage payment when you put a down payment, how much is a monthly insurance cost, the monthly property taxes, and the maintenance, and keep at the end of the month, if the rent you collect is higher than the subtotal of all the expenses and the debt obligations, and you still can achieve a positive cash flow, that means potentially is a good purchase. So furthermore, moving forward, when I guide my investors moving forward, then they have to pivot, right? As an investor, we have the ability to adapt and adjust to what's going on. Perhaps I don't recommend my investors, my mom and pop real estate investors, and we work with so many of them over the past 20 years, hundreds and even several thousand. We do not buy in the coastal area. We do not buy in the flood zone. We do not buy rental properties in the hurricane infected area by the coastal areas. And we don't buy condos that have a high HOA fees. And we've been doing a good due diligence. So you investors out there, you have to create a buy box. You have to create a criteria where you can minimize these kind of issues, insurance costs or otherwise. All right. So your future research and due diligence and the methodology and your investor buy box will be changing. So just look at my information that I'm showing as a benchmark to you need to look at buying rental properties differently moving forward. Okay, not just from what you are hearing from this video, but from other issues that you may need to consider, whereby in the past years you may not have considered insurance or HOA or property tax issues or weather-related conditions. Now things have changed drastically. We have seen a lot of recent information about global warming and weather-related areas throughout the U.S. All right, let me finish up. Home insurance premiums have been increasing faster in coastal states, of course, particularly around the Gulf, with the average Texas homeowner experiencing one of the largest increases last year at 20.3%. Wow, that's pretty much double-digit insurance costs. So if you buy a fairly expensive home, $500K homes or higher, then your monthly cost of insurance could be several $100s. However, if you buy a cheaper rental property, less than $300K, that will be ideal for our investors because that number makes sense. Then the increases in insurance premium will be less severely impacted on a monthly basis, and it should not affect your so-called monthly cash flow that significantly. So does that make sense? All right. Anyway, so further, the rise in home insurance premiums is due not only to climate risk, but also to housing and construction inflation. Wow, housing and construction inflation. And also, let's talk about that. And replacement and repair costs have soared. See, all those issues that are not even related to the weather conditions can increase your insurance costs as well, right? Think about that. Housing and construction inflation, replacement and repair costs, all those things will impact the insurance monthly premium moving forward. All right, keep that in mind. So let me then recently, Case-Shiller National Home Price Index rose 1.2% between March 2024 and April. This is month over month. But since 2022, the last couple of years, Case-Shiller Index Home Price Index shows a positive 4% growth. And year over year, Case-Shiller National Home Price Index shows 6.3% year-over-year increase in home appreciation nationwide. As I'm concluding this, furthermore, let's go over the big picture. Let's go over what Case-Shiller have concluded. Let's talk about appreciation a little bit more. Okay, in the 2020s decade, which is the past four and a half years, right? We are in the middle of 2024. So in the past 4.5 years since 2020 started, we have already seen more home price appreciation than the total of the 1990 decade, the total of the 2010-year decade, and the total of the 2010 decade. So in 4.5 years, we have more appreciation than 10-year increment in the past 3 or 4 decades. All right, that's what happened. So through the first 52 months of the 2020 decade, home prices have increased a whopping 51%. Normally, on historical home price appreciation is anywhere from 3 to 5% on a 100-year real estate cycle. But if a property increases at 5% annually per year, in a 10-year mark on a historical basis, it increased like barely 50%, right? But in 4.5 years already, in this decade, the home prices already doubled the 10-year average in the past 4 decades at 51%. Does that make sense? And this graph is showing that. See, year to date, 2024, for the past 4.5 years, 2020 is 51%, and the previous 3 decades, the 10-year cycle, have 47, 44, and 30% accordingly in the year 1990, the 2000s, and 2010. So for those of you who purchased a primary home or investment property in the past 4.5 years, congratulations, you are the winner. You are standing in a winner's podium, winner circle. That people, for whatever reason, they procrastinated, they stay in the sideline because of fear, doom and gloom. For whatever reason, you did not take the plunge. You stay on the sideline for the past 4.5 years. I hate to say it, you're the losers in this housing market growth. Okay, so I hate to be so harsh. All right, so I think that's pretty much conclude this presentation. Now, I want you to show something else that may interest you a little bit as I conclude this. So I want to show you for the remaining 5 minutes that we have. Okay, here's my philosophy that I have incorporated on a personal basis, and also when I work with mom and pop real estate investors out there. I use this quite often. If you've been watching my YouTube channel for the past few years, you will know that I love to use this graphic. Warren Buffett, the greatest investor in America, Warren Buffett, a long time ago, he said, be fearful when others are greedy, and be greedy when others are fearful. Now, you would agree that a lot of people out there in the housing market are very fearful because of the negative situation, inflation, recession, the alleged housing crash, correction, the economy, all those doom and gloom negative information that makes a lot of people very fearful. So I'm a capitalist. I like the word capitalist because I capitalize on other people's emotional instability. I hate to say this, and I feel there's always opportunities, not just for investors. Myself, as an investor, I have invested in many markets over the past more than 20 years, and hundreds of my investors follow my lead, buying in the good areas in the country where you can cash flow, you can buy turnkey property with cash flow and buy and hold long term. But having said that, so again, you should be if you're motivated, you should be a capitalist. You should be greedy right now, be a capitalist while everybody is fearful because there's so many deals out there, so many great real estate deals out there. If you are an investor, if you're a primary home buyer, hey, listen, if you could afford it, if you have a long-term buy and hold strategy, if your situation is such that you need to buy a home for yourself and your family, and you have a good income, good stable job, good down payment availability, good credit, and good cash reserve, then by all means buy, right? Don't time the market. Do not time the market. It's time in the market. And another approach you guys should use, and I'm not gonna go talk too much about it because I don't want to make this a long video. You need to be a contrarian investor. Okay, everybody, the majority of the herd go one way, you go the opposite way. Okay, be a contrarian investor. And also another philosophy I have adopted for many years, and I continue to buy property. Doesn't matter what real estate cycle I buy. I use the dollar cost averaging principle, which is a lot of you have been hearing the dollar cost averaging is only for the stock market. No, you can apply for real estate market as well. So dollar cost averaging is a practice of I switch everything around. To me, it's a practice of buying rental properties regardless of the real estate cycle, because I invest for long term. So I buy and hold strategy for more than 10 years at a time, and I ignore the short-term volatility as long as I collect the cash flow, as long as I collect the rent, and the renter going to pay down my loan, the renter going to pay off my mortgage, my debts, my expenses. I still have a positive cash flow a month over month for years to come. Then the market will come back, right? And then I'll get the equity and appreciation on a historical basis. Dollar cost averaging is never wrong time to buy. You buy because, and just everything will stabilize, will rectify itself. One more thing I want to go over. Okay, when you buy a rental property, and I discuss this quite often on all our videos about real estate investing. rental property. There's four ways you can make money. Not just about cash flow. I cannot dive too much deep into this. But buying rental property will give you 4 profit centers: cash flow, tax benefit, appreciation, and leverage. You buy in a 7 to 10 year cycle, hold it for long term, then you will achieve more cash flow, more tax benefit, appreciation potential long term, and you use the power of a 30-year fixed rate mortgage. So you can, by using leverage, your returns are much higher. And in terms of properties, let me skip. You can into some of the property you buy in the Midwest, buy for high cash flow, surrounding yourself with a good property manager and turnkey provider in the local market. Do your research. Midwest, very low price, older properties, but they are turnkey. They've been rehabbed. You can achieve very good cash flow in the first year alone, and overall, a lot of good returns. If you look at the numerical metrics over here, which I'm not going to go over, you can pause this slide and digest each of this slideshow. You can buy duplex for $117,000, very good high rent, higher than 1% rent to value, amazing cash flow right here. You can buy fourplex, only $173,000 in the Midwest, in this case, Buffalo, New York. Look at this monthly net cash flow with 25% down payment, even with elevated 7% mortgage rate, you can still cash flow significantly. Then, of course, you dig the rate and marry the house, okay? That means you can always refinance later when the mortgage rate comes down. When you refinance your rental property in the future, your cash flow will be even higher than what's currently showing, okay? And then buying Alabama, buying the Sun Belt in the South and Southeast still really makes sense. You could buy a new construction, single-family home in a good area in Alabama for $240K, rents for $1,725. Get a builder's buy down 5.5%, 30-year fixed rate mortgage. You can cash flow monthly at a whopping $364. And for those of you who think the Florida is no longer a good market, with all the negative information you've been hearing about everything, but no, it's not true. If you go to a great location, you buy inland, you buy away from the hurricane, you buy away from the insurance crisis, you buy in a non-flood zone, you buy in an emerging growth. There are many locations in Florida. You can purchase inland. You can get some great price. You buy a new construction, very low price for a single family home, rented for almost $1,700. Cash flow, you could get a builder's amazing rate buy down 4.75%. So great cash flow, single family home, year-over-year growth, or the numerical analysis. And you can buy a duplex, brand new also, very good cash flow, and rent it both sides in great areas of central Florida, for example, away from the weather-related conditions and insurance crisis we talked about. Even a fourplex, $800 or $1 million, you can purchase with 25% down payment. With a buy-down rate, you can cash flow very significantly. And of course, Texas still is all about what location, is all about specific location. Real estate is hyper-local, so this fourplex, brand new, located in Texas for only $545K, rents for $5,400. So you put 25% down payment, even with a mortgage rate of 6.8%, you can still cash flow almost $800 monthly. So this is just a sample. Oh, one final thing. Once you build your real estate portfolio in the next few years, doesn't matter how many property you buy, 1 to 5 to 10 property in the next 3 to 10 years. When you buy a turnkey property you allow property managers to manage it for you. So in the end, you spend 1 to 2 hours per month managing your real estate portfolio. So with that said, I'm pretty much done. This is just a bonus I'm providing you, other than the main headline of my video, which is the insurance crisis. So it's not doom and gloom. So as an investor, if you own homes in this weather-related challenging area and your cash flow being decreasing, you may want to think about your some kind of exit strategy, right? How should you sell? Should you do a 1031 tax-free exchange, buy non-weather challenged areas of the country? Anyway, so as investors, it's very challenging, right? We are in a new normal, so you have to pivot. You have to look at each information that will impact your real estate portfolio It's not doom and gloom. Don't tell yourself, "Oh, I'm not going to buy rental properties anymore because of these issues." No, there's a loser's attitude. Don't do that. There's always opportunities as investors. There's always opportunity to find some great deals because there are more than 3,000 counties in the U.S. and there are more than 6,000 cities in the U.S. There's somewhere, somehow, you can buy great deals in this, even in this challenging real estate market. For homeowners, same thing, right? You have to rethink where you want to move to from now on. If you do not want to move into a weather-related impacting area, then continue to do your research and watch my videos, and I will give you more great, realistic education, not doom and gloom from the housing crash bros out there who give you a lot of brainwashing, doom and gloom. The world is coming to an end information. So avoid those non-credible sources out there. With that said, if you receive any value whatsoever from this video, please like and subscribe to my channel and comment below. Share with me about what challenges you're facing as an investor in your neck of the woods. Doesn't matter where you live in the country. Comment below. I'll be more than happy to respond. And finally, just put your email into our website below under newsletter sign-in box. Become a real estate insider with our real estate investment club, if you will, so you can join several thousand members. Free member, by the way. Everything's free. When you put your email on our website, you will be providing pretty much a daily dose of great contents, email newsletters about all aspects of real estate investing, opportunities, education, and also for primary homeowners, home buyers out there, you can also benefit from being part of our YouTube channel as well, because I provide frequent housing market updates. All right, so this video have gone longer than usual, but there's so much to share. I got so much information I want to get out there. All right, thanks for watching. Take care, and I'll see you on the next video very soon. Have a nice day. Bye-bye.